Hey guys, welcome. Alrighty. Okay, for those who just joined, most of the time in our system we're taking mean reversion trades, but once we start trending, trending is a two-stage process. Stage one, touch the upper Bollinger. Stage two, single candle with a higher close. We start trending on this bar, and every time we get the highest close in the trend, we check, is it on an uptick or a downtick in ATR? And you can see the ATR value here is 300 and then 299. So according to our rules, we're going into trend following mode. We're in decreasing volatility, and we stop taking mean reversion trades, and we start looking for trend following trades. Let me just get my trading platform set up. I'm waiting here. Let's see. All right. So hold on one sec. Let me just. Okay, we have a setup there that I was. 3.0. No, we don't have a setup. This is almost a setup. It needs to touch the 8 EMA to be a setup, and it doesn't. That's lucky. I'm just going to deal with a problem with my virtual machine right now. One sec. Connections. Alrighty, this could very well be a setup. So I'm gonna prep an order. If this is a hammer candle, we have walking up the outside Bollinger on the 10 and on the 5. And it's probably not going to be a hammer, but if it does, our order is most like when we see ATR around 300, that means that the average pip size is 3 pips. So it's almost certainly going to be a 3 pip stop, 3.5 pip target. And I'm just going to enter that in. Six, doke. And so now what we have to do is wait for this bar to close, and you can see it's 15 seconds to go. This may or may not close as a hammer. It has to close in the top half of the range for it to be a hammer. It doesn't look like it's going to be a setup with 7 seconds to go, but you never know. We got to be ready. And it is a setup. No, it's not a setup. Oh, shit. Okay, not a setup. For the guys who are watching this for the first time, the big difference between the better traders in our group and the more average traders is the better the trader is, the more willing they are to, in general, to place an order that's never executed. So even though that wasn't a setup, I had the order prep ready to go. And that's what good trading is, just being ready. I'm kind of annoyed that wasn't a setup. It was actually set up on my Interactive Brokers data feed, but not on, yeah. Oh, well.
Hey, Scott, can I ask a question?
Of course you can.
Well, two questions actually. So first of all, really basic question.
Sure.
with the RTC setups,
Mhm.
if it doesn't trigger the bar after the setup, do you cancel it straight away or do you wait?
RTCs, yes. RTVs, no. But in a practical sense, most often an RTC is an early bite of the cherry on an RTV. So, for example, if we go back to here, this is both an RTC and an RTV setup. So because it's an RTC and an RTV,
Yeah.
if it's both, you don't cancel it because it's still an RTV.
Yeah, and when you would have, let's say, 2 hammer candles in a row,
Two hammer
then
candles in a row, you cancel it until you get the higher close, lower close that makes up the RTV. That's a good question.
okay. Second, so I actually did some analysis on the RTC trades, and what I actually found is that the expectancy doesn't seem to be very good for the RTC setups.
Let me check.
Sorry?
Let me pull some data now. I didn't keep the stats right early on, but
Yeah.
what's the expectancy that you found?
Interestingly enough, so I'm doing it algorithmically, and what I found was that overall the expectancy is pretty low, but I'm keeping track of like opposing confirming evidence. So if you would have confirming evidence on the other side of the trade, and if there's no confirming evidence on the other side of the trade, then the expectancy is really high.
Sorry, could you explain that again? That's kind of interesting. Yeah. Let's go through.
So let's say we're going long, and so I'm keeping track of the opposing confirmed evidence. So let's say
if you're going long,
yeah.
So if you're going long, you're keeping track of whether you're walking outside the Bollinger Band going down. Right?
Yeah, like that. If there's short confirming evidence.
And on the higher time frame, or on the higher time frames, you're keeping track of it.
Sorry.
On the higher time frames, on the 5 and 10.
Yeah, correct. Yeah. Okay. And so if there's no conflicting confirming evidence, let's call it, then the expectancy is really high. But otherwise, it's pretty low.
Wow, that's amazing, dude.
Yeah.
That's
yeah.
Would you be able to shoot me an email with your findings? Because I'm super interested in that. Let me give me 2 minutes and I'll pull some data on our own shit here, and I'll just sort it and I'll see if that matches up.
Sure. Yeah. So this was over 67 trades. So 67 trades where there's no conflicting confirmed evidence. The expectancy is 0.3.
67 isn't enough. That's
yeah. Yeah, no, that's true. Like it's a relatively small sample.
Yeah, that's yeah. Let me give me 2 minutes here and I'll pull some data.
Yep.
Okay, so on average, actually, no, that's not quite right. 1 more minute, please. Okay, so on our larger data set, there's very little difference between RTVs and RTCs and expectancy, but the RTCs are 3.9% better. So I'm definitely interested in it, but I definitely wouldn't. I definitely want to run it over a larger data set. If you're doing it algorithmically, that shouldn't really be a problem. Right?
Yeah, still planning to do it over a few years. So
I think so.
Was over about a year.
One thing that you might want to keep into account if you're doing algorithmic stuff is in any intraday systems, there's significant time of day edges. So most common in most markets, the edges that arise are around the open, the close, and the lunchtime period, which can go quiet. So it's not unusual for you to find very significant time of day edges between those different times.
Yeah, no, I found that as well. I think between 6 and 7 a.m. Your time, it wasn't really the results were not very positive, like weirdly just 1 hour.
Which market are you tracking?
Euro dollar as well.
Mm-hmm. One thing you might want to consider is that futures are a better market for algorithmic traders because the data that you're backtesting on is the same as the data that you use going forward. FX data can be a little hinky. It's different between every broker. It's kind of budget, but futures data has just got a lot more trust and solidity to it.
Yeah, no, I downloaded the same FXCM data as as you use for the journal, so I could compare it with the with the journal you have. So
we even find weirdness with FXCM data, and FXCM is the biggest data feed. It's the best. It's the best capitalized one, and from time to time we find them backdating a candle close, like a up or down a half a tick, or like weird stuff.
Yeah, like if you reload a chart as well on TradingView, sometimes the data just changes randomly.
Never used to do that, but yeah, it's a frustrating thing. It's the world of retail trading. What I suggest, if you're automating the system, is you can put in subparts of the system and end up with something much better than what I can do. So the easiest way for you to improve the system is to take the strongest parts of it, which aren't practical to do as a manual trader. So the strongest parts of the system by far are hammers and shooting stars touching up with a deeper pullback to the 21 EMA, and trending confirming evidence, Bollinger trending, and walking up the Bollinger confirming evidence is so strong that you could get away with having only one out of the two time frames as confirming evidence.
Yeah, I've done analysis on all those as well. Yeah, again, still would like to do it over a few years, but Bollinger and trending confirming evidence seems to be the stronger, like specifically Bollinger on the 5-minute and trending on the 10-minute.
Exactly so. Exactly. Yeah, it's actually, in a practical sense, it's almost impossible for it to happen the other way. If you think about the market conditions that could give us a Bollinger touch on the 10 and trending on the 5, I can't even understand how that would happen. So I've never seen it happen.
Yeah, and another thing what I found kind of interesting is, which I didn't really expect, is a while back I tried it on different time frames. So for example, 5 minutes as the the primary time frame, and then 10-minute and 30-minute as confirming evidence time frames. And
I've always been interested. Yeah. How did it go?
It's not as great actually. Like the trend trades, they didn't really seem to be very good at all. So
what size data set are you working on here?
Always FXCM.
No. Like how much done?
Yeah, also just a year, so still would like to do it over like some more time.
A year should be okay. Like a year should be 1,000-ish trades, right?
Sorry, Scott, I think we've got a setup forming.
Yes, we do. Thank you, Julian. All right, so guys, we have a Bollinger Touch on the 5, Bollinger Touch on the 10. We have a setup forming, so let's prep the order because I was being a cunt. And the entry point would be 11.5, and the stop loss would be 19. And set 7.5 for 8 pips target, and I'm going to prep the order now. Thank you, Julian. It's not an order. It's not a setup, by the way. It didn't close as a higher close. So our entry setup, touch of the Bollinger, 1 or more lower closes. We're waiting on a higher close or a shooting star. One of the other things that I'd be interested in testing that's difficult to do when you're not doing it algorithmically is whether 2 bar, like this is, for example, a 1, 2, 3, 4 bar RTV pattern, whether, and this one here is a 3 bar. This one here is 1, 2, 3, 4 bar. I have a suspicion that 2 and 3 bars are a stronger edge, but that could just be my wishful thinking or bias. So if you're looking for things to test, that would be right up the top of my list too.
Yeah, okay. Yeah, I could try that. One other thing we're also trying to look at is to see if there's any correlation with the ATR. So
okay, so I can save you some time there. Very low ATR is a very low edge, and also it's a double whammy in that low ATR is also a small range setup, right? Because that's what low ATR means. It means small candles. So the effect of small candles is effectively that commissions take a much bigger bite out of your setup. So for example, if this was an order, it was a 3 pip stop, 3.5 pip target, commission would have been about 0.11, 0.12 expectancy. If this becomes a setup here, commissions will be almost a non-factor. They'll be 0.04 expectancy. So the effect of ATR is you want to measure with an estimation for commission as well, because smaller ATR means more comms, more brokerage.
Yeah, no, exactly. I was also wondering just if you can modify the targets depending on the ATR as well. I was just thinking if that would make any sense.
Yeah, that does make some. That makes some intuitive sense. I'd put a minimum in there. Yeah, that does make some intuitive sense.
Yeah.
Okay, so it looks like we're going to have a setup here. So our target is lowest low in 25 bars, the maximum target. It's going to be there. It'll be fine. Now, someone's yeah, that's looking suspiciously like this. It's not. Sharia, what do you think?
Yeah, Scott.
Hey man, how are you?
I'm good. How are you?
I'm a bit sick today, but bronchitis. What do you think about this?
Scott, I would say we should go for 25 bars for this.
Yeah, I think so too.
It's better to go for 25 bars rather than.
I just wanted a second opinion to make sure that I wasn't.
No way of playing.
I just wanted a second opinion to make sure that I wasn't just being a prick. Okay, so that would be 10. Sorry, the entry the stop loss would be 19, and the entry would be 8. Okay, so that's 11 pip stop for 12.5 pip target. Okay, let me get that order prepped. This is bad trading from me, by the way, because my order is not placed when it should be.
You're taking that line.
Okay. So this order is placed, but if it doesn't get filled, I'm going to have to prep a new order, which is going to be kind of difficult to do and manage. So I'll kind of show you the way that I do it. Okay, so we've got 40 seconds to go now. Our current order that's resting right here is 11 pip stop, 12.5 pip target, and that changes. So the entry becomes 11 and the stop loss is still 19. So it becomes 8 pip stop for 9 pip target. Okay, and placing new order. So it's really important to place your new order and then take the old order off and be kind of vigilant about it, because you don't want a situation where the market runs fast through both your orders and all of a sudden you've got a double position on when you didn't mean to. That can freak you out. And one of the things I'd say for people learning the system is that the times when things go wrong, it's very, very important to have a procedure in place, because it can be extremely stressful and it can be very flustering, like to have, oh fuck, I've got 2 orders on, where are my stops, where are my targets, oh shit, everything's wrong, fuck, I don't know what's happening. Like it's very important to have a set procedure that you go through every single time. And for me, if the rule for me is, if I'm ever in a trade that I shouldn't be in for any reason at all, no matter if it's making money, losing money, or anything else, I immediately exit that trade at market. And what happens when you find yourself in a trade that's kind of incorrectly placed or whatever, is that you immediately start hoping it works or hoping it doesn't lose you money, and then you give it another bar, you give it another few seconds, and then you're stuck. So immediately, in profit, in loss, no matter what, just jam the button, mash the button, get out. That's my advice. All right, so we've got a new bar, and I'm just going to drag my order up to the low of the next bar. Should be 25. So let's take a look at that in a bit more detail. So we placed the order here, prepped a new order, which was a different size, placed it here. Technically, what I should have done is prep a new order and placed it here, but the difference between these two isn't that much, like 11 to 12, another pip. Fuck it, I'm just a bit lazy. My position size will be a bit out. I don't give myself too much grief over stuff like that. My priority is getting the order on every time, absolutely. So what that will mean is if it gets triggered now, it's going to be slightly too far away on the stop and slightly too far away on the target. So once it's filled, I have to remember to go and adjust everything up and double and triple check everything just to make sure I haven't fucked up. Righty, with 20 seconds to go, it seems 15 seconds to go, it seems likely that I'll have to move this order up a little bit from 12.5 to 13, moving up a half a pip. To 9 and moving it up. Okay. Kieran, if I just drag my order, the volume of the position is wrong, and sometimes being perfectionist is the enemy of sometimes perfection is the enemy of the good. And so what I mean is, I will replace and recalculate the order to get everything perfectly correct if I have absolutely time to do it and have there be no danger of me ending up with no order on while the market moves through my thing. If there's any danger of me fucking it up at all, and in here between, if I cancel this and put this one on, it's going to be extremely possible that I have two orders on at once that get filled immediately because because these are so close, or that I cancel this one and don't get this one placed in time. I could easily find myself looking like a right cunt. So my priority when trading is to get an order on, just get something on. If I can get it perfect, yeah. Does it bother me too much if my position size is out? Not really. Not really. Now, the setup gets canceled once we break this high.
And we might possibly end up in DV. So
Yes, we could very well. Good catch, my man. Okay, so what Sherry is talking about is every time we get the highest close in the trend, the last highest close in the trend is here. If we break that high, which we're going to do, if this happens on an uptick in ATR, it's fine. If it happened on a downtick in ATR, which it didn't, then we'd be in decreasing volatility mode and we'd start looking for reversals. So now I am going to recalculate that order because that's getting a bit ridiculous. I should have done it earlier. So the entry would be 14, the stop loss would be 19, that would be 5 for 5.5. And let me just place an order quickly. Okay. Okay, so while we're waiting for this order to fill, which is at 14, 5 pip stop, 5.5 pip target, what I want to point out is that we started off with like a 11 pip stop, 12.5 pip target, then we moved to a 7.5 pip stop, 8 pip target, and then I think it was I don't know what these are, but this one's a 5 pips. This one's a 5 pip stop, 5.5 pip target, and I'm not quite filled yet. Is anyone else filled? Now, the implication of having those smaller ranges is twofold. One is we're swinging around a bigger position size, so we're using more leverage. And the other is that initially, when we started looking at this setup here, our target would have been roughly ballpark here. Then our target moved up to here. Then our target moved up to here. And now 14 less 5.5 is 8.5. And now our target is right here where my crosshairs are. And that is this is a much more attainable target than all the way down here. The other thing I want to point out to people who are interested in price action is check this out. We've gone down for 1, 2, 3, 4 bars. And then we've gone up for 1, 2, 3, 4, 5, 6, 7 bars, but we haven't broken the old highs. So we're going up, but we're going up in kind of a weakening fashion. So if ever you've heard the term distribution, this is what distribution looks like. So distribution is when sellers take advantage of a strong market to soak up their orders. And you can see that's what's happening. There's a lot of buying pressure, but there's a lot of selling pressure as well. So that distribution is the change of market participants from the guys who bought in here to the guys who, those guys who bought in all the way back here are now starting to bank profits. And this is the visual representation of what they're doing. Okay, this looks like it's probably going to break these highs and break out from here. All right, I'm going to drag my order up to here. Okay, we might get a fill. Let's see. So the beauty of having rules is I thought that the market looked like it wanted to reverse and it was showing signs of that. And now it may not reverse. I'm not stuck in that awkward position of being stuck emotionally with my opinion because it doesn't fucking matter. Like the setup is on until the setup is off. The setup gets canceled when price breaks here in the story. So it doesn't force me into the position of having to like pretend that I know what's going to happen next. All right, looks like we are getting it set up here. Okay, I've got to fill now because I just dragged the order up. Got to make that right and work out where my stop and target should be. Okay. The entry was at 15 and my stop loss is at 19. So it's 4 for 4.5. Ten less 4.5 is 10.5. All right, so for those of you who aren't at the live trading stage yet, once you're in a trade, there's an extremely dangerous thing happens. And the dangerous thing is that you want to be a dickhead and just like pin all your hopes and dreams on this one trade, and you want to watch it like it's a racehorse and cheer it on and all that sort of bullshit. That is extremely emotionally fatiguing. And every second you spend doing that probably takes an hour off the amount of time that you're good for the rest of the day. So don't do that. And instead, anyone got any questions so far? The stuff you've seen? No questions? Any more algo stuff? Robert, you got some questions?
Not so much a question, just an observation. How the hell do you calculate that so fast? By the time I sit there and do all the calculations on it, I'm guessing it's just practice. I think I know the answer, but
no, it's not practice. It's me treating myself like I'm stupid. I have a scrap of paper next to my, I don't have it today because I know them all now, but I get an A4 piece of paper and I go 3 pip stop, 3.5 pip target is 1,650,000 position size. I know 3.5 pips stop, 4 pip target is 1,440,000 position size. And I write them down on a scrap of paper because it's too slow when you're doing this in real time to have to like go to a spreadsheet and figure it all out.
yeah, because that's what I've been doing, is typing it all into the spreadsheet to figure it all out.
Okay, so when I first started doing this trading system, I was dead set on you have to do the spreadsheets in real time. And I would use the bottom row of the spreadsheet as a scratch pad and just continually update position size. And I found it really emotionally fatiguing. And we thought, Daniel and I thought it was best practice. And we continued to do it that way for about 4 months. And then one day Daniel had like a 4-hour losing day. And we used to meet every day for coffee at like 11 in the morning, and we do our daily reviews together. And he was just disheartened and he'd made a couple of mistakes and he'd had a couple of losing trades, and he was like on the verge of tears. And he's a professional trader. He's probably a better trader than me. And he just said to me, Scott, I don't think anyone in the world is good enough to trade the system the way we're doing it. And I thought, well, you know, this is a guy who was so good at trading that I literally employed him years ago to trade my own systems because he was better at it than me. And he was telling me that he didn't think anyone in the world was good enough to do it the way that we were doing it. And he's right. Like, it's just much easier to have a scrap of paper and do it in real time and then come back the next day and fill out your spreadsheet. Doesn't take long.
Yeah, I think what I've got to get my head around more so is the actual pip calculations.
Okay, let me show you how to do it. Maybe Pip's position size calculator. If you Google it, it's your friend.
Yeah, so I've got that, but I've got that part. So I know I've got that bit down part. It's actually working out like is there a quick way to work out that it's 3.5 pips between the stop loss and the entry point? Like that's the bit that slows me down.
Okay. So this is an easy hack. So when you look at this bar, you see how the numbers on the low are like this big long string of bullshit, right? 1.153. Ignore everything but the last three numbers. The last three numbers on the low are 153, correct? Sorry, 149 now.
Yeah.
So let's say that's 153. Instead of saying it in your mind as 153, say it as 15.3, because that's what it is. It's 15.3 pips.
Okay,
so, entry point is 15.3 pips. The stop loss is 187 is the final three numbers, and that would be 18.7. So the next bit above 18.7 is 19. So
yep. And so it's literally just 19 minus, we'd go to 15 for that one. So
19
it's literally
minus 15 is 4.
Yeah.
And when,
okay.
When you break it down like that, it's maths that even I can do.
Yep. Okay, that makes sense. Because yeah, that's the bit that's been doing my head in is trying to.
Sometimes I forget like it's the little stuff that you get from actually doing it. All right, looks like we're going to hit the target here.
I'm out.
I'm out now. Yahtzee.
Yeah, I'm out as well.
All right. Now, I want you to notice the pinching formation of these Bollinger Bands. See how, if you think about how Bollinger Bands are calculated, the Bollinger Bands are an average of the last 20 standard deviations. Standard deviations measure the square of the differences. So what that means is that when these pinch very hard, likely the market is going to break hard in one or the other direction. So we will probably get a reversal set up here, and look at our confirming evidence will be probably trending, which would be a 2R target. This would be a very appealing, any setup we get here is very, very appealing. And watch how markets move from times of low volatility into times of high volatility, likely stays around low volatility for a while. It moves. Once these waves start going, they have kind of a momentum to them. It doesn't make much difference for trading. Like, you just take the setups you trade. But
Scott, while we're at it, can we go back and check 2 trades for this week on your
Sure.
baseline?
Yeah, just keep an eye on the price and tell me if we get a setup, please, and give me the setups.
Yeah, I would. The first setup is 13th,
Sorry,
3:30. 13th.
13th of
13th.
January.
Yeah, 13th January, 3:30.
Okay.
It's from the past week.
All right, 330, 256. I remember this. Lowest close in the trend is here, 957. Close is 959, not the lowest close in the trend. So this is not a, so we're not in decreasing vol, and this is not a setup. Lowest close in the trend on an uptick, so we're not in decreasing vol.
No, Scott. Sorry, I was talking about 3:30 RTV. No,
330 RTV long. Oh, didn't spot it.
you missed
My
it
bad.
actually.
Yeah, I missed it. Yeah, that's a setup. Okay. Let me put that.
I have the stats. I would do that. You move on to the next one.
Okay, thank you, man. Yeah, what's the next one?
The next one is 352. This is in the baseline, but this shouldn't be. We need to cross check this.
Okay. In decreasing vol.
Sorry, 352 on 14th of January. 14th January, 352.
Okay, 352. Are we in decreasing vola? We don't touch the upper Bollinger. We are on an uptick. That looks like a setup to me. Retest concept.
Just wait a second, Scott. The bar at 352 is the highest close in the trend on a downtick on the ATR.
You are correct. Shouldn't be in.
Yeah.
Okay.
And we started trending at 350 because the Bollinger touch was at 310.
Correct,
So-
correct. Nicely spotted.
So yeah, so we need to
I deleted that one. Righty.
So the last week the stats are actually 3.6 R instead of 5.6 R.
Okay.
So
Not
should
too
I do this? The baseline, yeah?
Yeah, please. All right, any questions, guys? Anything that you're struggling with? Anything that you need explained?
I guess while we're waiting, Scott, can we go over my question to you in email about confirming evidence for trend setups?
Of course we can. Let me just grab your email. Do you want to just repeat the question?
Yeah, so basically what I'm wondering is, so I get with the the decreasing volatility and trend setups, and you're looking for hammers and shooting stars. But what I wasn't sure of is, what's the confirming evidence for those, if any? Is it the same as everything else,
The
or?
confirming evidence is the same as everything else, but only for simplification's sake. In a practical sense, it's almost, for example, if we've got a decreasing volatility uptrend, it's almost impossible to get a lower Bollinger touch on the 10, right? So it can be any of the different types of confirming evidence, but in a practical sense, it's nearly always either walking up the Bollinger, decreasing volatility mode, or trending pullback. Nearly always, like 95 times out of 1.
Yeah, okay. And you're looking for that confirming evidence on that shooting star or hammer candle, correct?
But what I do is the way that I run my head for all this stuff is I don't keep track of confirming evidence because there's a reason to. Because if I'm going to like juggle 3 charts and what's going on all the time and keeping absolute track of it, it can be fatiguing. So what I do is I wait until I'm in a trend before I start looking for decreasing volatility. Trending is a 2-stage process. Stage 1, touching up the Bollinger. Stage 2, single candle with a higher high and a higher close. So now we're trending, and now the highest close in the trend happened on a downtick in volatility. So now I'm in decreasing volatility. At this point, I will take a quick glance and say, well, is it likely that I have confirming evidence? And looking at this, I can see that at the close of this bar, we're already on this bar on the 10, and we're walking up the outside of the Bollinger. And here, you can see that we've been walking up the Bollinger for a while. So I'm 90% sure I'll have confirming evidence. And then what I do is to simplify the order taking process, because these hammers come at you pretty fast, right? What I do is I look at the ATR value. If the ATR value is 300, that means that the average pip size over the last 14 bars is 3 pips. So I'll prep a 3 pip stop, 3.5 pip target. And if that's not exactly right, then fuck it, who cares? I'll just drag it into place. Near enough is good enough with it, because these hammers and shooting stars come at you really, really fast. Like this one looked like it was going to be a hammer. At the last minute, it wasn't. Pain in the ass, because that was a winning trade. And then just as I'm placing the order, I'll just do a last second check, the last minute check, like a clipboard, like a checklist kind of thing, and go, do I have 5? Yep. Do I have 10? Yep. Okay, good to go. Bang.
Yeah, okay, makes sense.
All right. I'm still hoping I'm getting a setup soon. I'm going to take a toilet break. I'll be back in a minute. Okay, I just want to talk for a minute about statistical significance when you're like pondering modifications to trading systems. So for example, the gentleman who was on here earlier had tested RTC setups and found them to be a poor edge on a small sample size. One of the things that you should always do is throw your set of raw data into a spreadsheet and use the Excel formula equals STDEV equals standard deviation and work out what the standard deviation is. And just add 1 + 1 and then -1 to whatever expectancy result you get. And just realize that things are going to naturally fluctuate up or down a standard deviation because that's what, that's just like totally normal. So one of the things I asked myself is, if it was 1 standard deviation up, would this change my thinking, or 1 standard deviation down? Would that really change my thinking? I paid a guy with a PhD in stats once to try and answer the question for me: how much back testing do I need to do to establish statistical significance? And I paid him a couple of $1,000s, and he went away and worked, and he came back a month later and he gave me my money back and said, I don't know what the answer is, but it's going to take me more work than a couple of $1,000s to figure it out. And I don't think you're going to like the answer, and it's going to change for every single system, and it's not something you want to do. So in a practical sense, we never really get enough backtest data to be sure of anything. That's one of the things I know about trading, is that even, we've got a very significant real world track record now, and it's still not enough. Yeah, it's just something to keep in mind that just something to keep in mind. So there's a number of hacks you can use to work around that by pulling data out and keeping it clean, and then not doing any of your calculations on that. You can run it on different markets and different timeframes. You can do all kinds of little tricks, but they're all little tricks to overcome the fact that we really don't have, like, if we ran this on a 50-year data set, it probably wouldn't be enough to know for sure that the system's not gonna stop one day. All right, hopefully we get a setup here.
So just to double check myself here, if this ends up turning into a setup, would I be correct in saying that the confirming evidence would be trend?
Correct. Now, it's also possible that you have more than just trend, right? Like it could be also decreasing volatility, but you only need one. Once you have one, you stop looking. So as soon as you can see something that's definitely confirming evidence, it could also, in theory, it can be walking up the outside of the Bollinger and trending, but as soon as you see one, there's no need to get pedantic. One of the real mistakes that I see people making is getting overly pedantic about this stuff. It's a job. It's like you just do your job and clock off. Okay, so we have a touch of the lower Bollinger. If this is a hammer candle, without breaking the low of this bar, which it's almost certain to break, then we'll have a setup. I won't prep that order because the low is 0.86 and we've already broken it. We don't have to worry about decreasing volatility mode because we can never go into decreasing volatility mode up while decreasing volatility mode down while we are trending up on the 5 and trending up on the 10. So we don't need to consider.
So Scott, just backing up a second, is that a rule or is that just something you've never seen happen?
No, it's a rule.
Oh, okay. Another one to note down on my scrap of paper.
Exactly so.
And just to triple check, it's trending up on the 5 and the 10 or 5 or the 10?
And
so it has to be both.
Has to be both. And so in a practical sense, maybe we'll see this happen later on, but so for example, on the 5 is the one where it's going to change first, right? Because the 5 moves quicker than the 10. So once this 5 hits the lower Bollinger, we still have confirming evidence. It's just lower Bollinger touch instead of trend with pullback. It's a trend with pullback, trend with pullback, trend with pullback until it touches here. But the moment it touches, we're not trending up on the 5 and up on the 10, so we can go into decreasing volatility. Now, the expert trick with that is that you don't automatically jump back into decreasing volatility mode for reasons that are kind of difficult to explain, but very practical. You just become open to the next candle that has the lowest close in the downtrend, throwing you into decreasing volatility mode. Does that make sense?
Yeah, makes sense.
Cool. All righty, we're looking like getting a setup here, and that is very appealing price action. We see like an engulfing bar. The market has tried to go down, said, no, fuck going down, and it's closed above the previous open and above the previous close. So what does that tell us? It tells us that this market has tried to go down, and instead, fuck that, I'm going up. So now we have to start being really aware of a long setup. So I'm going to prep this order now, just in case. So the last 3 digits past the H, the high, 104, which is 10.4 or 10.5 now. The low is 5.4. So our, well, it's changed again. It's not going to be set up. So I'll wait until we have a more likely setup, and then I'll recalculate.
$19.5 is the maximum target range.
Thank you very much, sir. All righty. To close 99. Okay, so we have a lower close, so we have a setup, and I've been a dick and haven't placed my order on time.
Not high tide, Scott.
Not
You
high
need
and
to check
tight.
it.
Where was the target?
19.5 is the maximum, I would say. The target is 20.
Oh, that's okay. We're in an uptrend. What are we? It's a bit borderline. Yeah, you're right. All right. We're going to get another setup here. I'm going to prep this order now. So the entry point would be 10. The stop loss would be 5. So that's 5 for 5.5. Same order as last time. Sorry, 5 for 11. 5 for 10. Sorry, my bad. Because we're going for 2R.
This one's a much better risk reward.
Much better. And when you're dealing with smaller values, even a pip moving closer makes the target a lot closer too. Especially when you're doing 2R targets, makes the target, you know, dramatically closer. Okay, 10 seconds to go. Check that. Oh, that is a beautiful looking setup. So why is it a beautiful setup? Because in any really good setup, there should be enough of a sniff for the other side. Chris, I posted this. I've got a really good friend who's a Maori lady. She's a very dark New Zealand lady, and she's got the most beautiful half black kid, and she's always told me that, you know, whatever. And anyway, we have a little in-joke that white people are always stupid, even though I'm white. And I posted something about it on Facebook to her, and I got myself banned off Facebook for 3 days. Did I post? Anyway, the comment goes against our community standards on hate speech. Fun fact, white babies are ugly, and they are, by the way.
Yeah. I allow shirts like Kill a Republican and that sort of thing.
Yes, so if you've been posting to me on Facebook the last, I won't be able to answer for another couple of days. So, yeah, send me emails instead.
What do you got, 24 hours left or 48 hours left?
I don't like the 5-minute closing below the EMAs.
No, it's not looking great so far. You never know. Certainly the odds have decreased since we got into it, and now it looks really shitty.
Yeah, we've broken the low.
Let's check if my stop is hit. I'm out. All right. Okay, it's in this situation, it's very important to stay alert for a potential new setup. It's quite common for you to get stopped out and then a runaway winner. And what happens is if you miss it after if you miss a winner after you've taken a loser, very few things will make you feel like a prick like that.
I wouldn't like another setup before the 5-minute touches the Bollinger,
I agree. I agree. I think
but
it's
but it's not about the opinions. If we get one, we'll have to take it. But it's just, you know.
I'm with you, man. I'm with you. Jeff, fucking look at that. Okay. Showing an unexpected sign of strength. We have to start thinking about setups again. Yan P, this is exactly what we were talking about. Nicely spotted. All right, so if this closes as lower close, this is going to be an order. And the entry would be 7 pips, and the stop loss would be 2.5, which would be 5.5 for 11. So I'm going to okay, so if this closes a hammer candle or a lower close or both, we're going to be jumping into this trade. That is not going to be, oh, maybe it is. Okay, so I'm going to have to adjust that up. I'm going to do that afterwards. My position sizing might be a bit wrong. 7.5. Okay, not a setup. Not a setup with 7 seconds to go. Still waiting on a lower. Not a setup. Ugh. All righty. It would be an entry of 8.5 and a stop loss of 2.5, which would be 6 for 12. Okay, so we are at 35 seconds to go. If this closes a hammer, it'll be a setup or as a lower close. Not a setup. Not going to be a setup now. All right, now it looks like I'm probably going to have a setup, but I said that before. All right, so the entry here would be 9.5 and the stop loss would be 2.5. So that would be 7 for 14. So I'm going to prep an order just in case, even though I've been made to look a fool. And it's going to make a fool of me again, no doubt. All right, we may have an order after all. So 9.5, 30 seconds to go. May not be an order. No, it's not an order. All right, this might be one of those annoying times where the market runs away without getting us filled. That'd piss me off, but lots of things piss me off.
I'm seeing what you mean about the emotional side of it, though. It's you know, it's sitting there watching it, and then just at the last minute, it takes off on you, and it's like so close to a fill.
So what happens is that when you sit here for an hour without taking a trade, you just want to take a trade, yeah, and you get a little whiff of one. You're like, fuck yeah, let's go, baby, come on, it's action, give me action, and it's irrelevant. The way to avoid so one of the problems with that is when you subconsciously desire for a trade to happen, you stop checking properly. Like your subconscious will just not do 100% check on everything and just go, look, I really want to fucking take a trade. Look, like just shut up. We're just putting this one on, and that can lead to mistakes. So the way to avoid it is that whenever you get those feelings of like, I really want to be in this trade, just express them. Just say to yourself or to whoever, or like write in your trading journal. If I'm trading by myself, I'll make a screen capture and make a little note. Just say, I really want to take that trade. And just saying, I really want to take that trade kind of takes the power out of it, because you know, once it's out in the open, you can see how stupid that is.
Admittedly, on the last two, I didn't even check whether it was high and tight. It was just like set up, set up, set up.
Exactly so. Exactly so. That's how it works. So your subconscious is like a 5-year-old kid, right? And as soon as it sees you having fun, it wants to get in on the game. And that can obviously be disastrous. Okay, so even though this is going to be a lower close, the target would be way too high. I'll check it just for being complete. So that would be 13, 2.5 is 10.5 for 12. 12 and 13 is 25, and the target would be, off the screen, like way up here, too far.
I was about to say, speak of the devil. I was just saying that, you're not checking high and tight, and then sure enough, it gives us a lower close, but it's not high and tight.
Exactly. But, who's to know we're not going to get one of those beautiful deep pullback entries that'll take us in here and be a much more appealing trade.
So while we're waiting to see what this would do, on the topic of high and tight, where would be the maximum high and tight range for anything in here?
Okay. Ever so slightly above the high. Now, in the direction of the trend, normally it's a hard lowest low in 25 bars, highest high in 25 bars. When we're in the direction of a dominant trend, we can go just a little bit past. And the reason for that is there's shorts and longs in the market, right? And for the last 30 or 40 bars, shorts have been accumulating their positions, and every one of those shorts has their stop here. You can just take it to the bank. So if it hits here, one tick above there, those stops are going to be run, and it's going to go like that. So if you look at a normal upper wick on a normal candle, like this, what happens just about every time we break new highs, it just busts out. If we find a trend, as soon as we break new highs, we're almost guaranteed to get like a little reaction. So I never quantified it, but the algo guys use a couple of different things, but I would say about a pip max would probably be about normal. But and the rationale is if your target was right here, it's still a good trade because it's very unlikely for it to get here without going to here.
Yeah, so I think it's Lenny Keys who's got the algo wolf trading algo that's been on the Facebook a bit. I think he wrote, yeah, trend in the same direction, just past the high or low of the last 25 bars, 1 to 1.5 pips.
Yeah, that's
That's
about
how
right.
yeah, it's what he's defined it.
You could probably extend that out a bit, like, but yeah, that's the way I do it. And don't forget that when we started this, we didn't have a statistically significant quantity of data. So you can't really be sure that my ideas on things are perfect. Like, I've thought it out as best as I possibly can, but I had like a 2,000 trade back test. I didn't have 2,000 real world trades when I started, right? Like, you never really know until you bet. And every month that goes by, you just get a bit more confidence in it, and the real world data matches the back test data, and it all seems okay.
So would you agree with some of his other high and tights? I think the other one that he's got is no high and tight in DV mode.
It's difficult to see how that would ever come into play, because high and tight is only an issue for Bollinger Touch, right? Like, it's rarely an issue anywhere else. So, yeah, I guess that makes some logical sense. I don't think there's enough of it to be a big needle mover if your returns either way.
Yeah, and his other one was if you're going counter trend just past the 21 EMA. So counter trend on the 5 and 10.
No, that's I wouldn't necessarily agree with that. I think you would want to break it up into confirming evidence if you're doing an algo that way. Honestly, highest high in 25 bars, just lowest low in 25 bars, isn't too bad. It's what I use like 70% of the time, and it's not a big issue for manual traders. And the reason for that is, let's consider the last 1,000 trades we took. Right? About 430 of the last 1,000 trades would be Bollinger Touch, which are the only ones that have a really controversial high and tight every now and again. And we know that the market spends more time in a trading range than trending. So by definition, of those 430 Bollinger Touch trades, probably 230, 250 of those are going to be obvious trading ranges or sideways high volatility ranges, and it's going to be obvious that highest high in 25 bars, lowest low in 25 bars. So of that 1,000 trades that we're looking at, we've got 180 trades where we're using it just past the 21 EMA target. Now, of those, probably about half of them are going to be totally I break it up into thirds. Probably about a third of them are going to be totally uncontroversial. That's crap. And about a third of them are going to be totally uncontroversial. That's good. And maybe a third of them are going to be, you have to apply your brain. So what's that? Like 60 out of 1,000 trades are somewhere close to the borderline. And of those, maybe 50% of those are really a hard thing to think about. It's just not, it just doesn't happen as often as people think it does.
Yeah, it makes sense.
It's not a giant big deal that some of you think it is. Any more questions, guys? Stuff that you don't understand, stuff that needs explaining, Any of the rules, any of the confirming evidences? Arnold has a good question. How do you use decreasing volatility as confirming evidence? Interesting question and really cool question. So when you have a setup, let's say we got this set up right here. We have 4 potential types of confirming evidence that we can look for. Now, of those types of confirming evidence, decreasing volatility is by far the least. So if I just pull my data over. So if you have access to my spreadsheet, and most of you do. So column AA and AB, Bollinger, this is 5 minute, this is 10 minute. So here's a decrease in volatility. Look how far we have to go until we find the next one. There's another one. There's another one. So my point is that they're there, but they're not everywhere, right? So what makes sense is to check things in the order that they happen in the real world. If we look at what happens in the real world, most of the time it's a Bollinger or a trend, and we check those 2 first. So once we stop checking those, once we have one, we stop. So if I'm looking for a reason to go long, once I have that reason to go long, it's an uptrend with a pullback to the moving averages, I stop looking. So I don't care if it's in decreasing volatility, which it may very well be. If I've checked, if I'm looking for a long setup here and I've checked lower Bollinger touch, don't have. If I've checked trend with pullback, let's say I don't have it. If I've checked walking up the outside of the Bollinger and don't have, then finally and last, I'll check decreasing volatility. And the way that you check, am I in decreasing volatility, is like this. First of all, we ask ourselves the question, are we in an uptrend? And we are. And then we go to the highest close in the trend, and we check 67, 66. So this is the highest close in the trend, and it happened on an uptick. Okay, we're not in decreasing volatility. Go back to the next one and check. But since we're at ATR highs after that, it's impossible for that to be in decreasing volatility up. And then I'll just check the 5 and go, the close here, 66, close here is 63, not the highest close in the trend. If you're at 8, one other useful thing to note is if you are at ATR highs, it's impossible to be in decreasing volatility mode. So that's all you need to check.
How far back do you go looking for those ATR highs?
Okay, there's 2 situations. One is the situation when we're at or around ATR highs. If we're going up like this, then you don't have to go back at all. If we're if we're going up like this, it's almost impossible for it to be in decreasing volatility mode. You just keep going. So if you think about how decreasing volatility works, you come out of it when you pop to fresh ATR highs. So you go back until highest closes before you make new ATR highs, if that makes sense.
Yeah, that makes sense.
Oh shit, we have a short setup, but no confirming evidence. So we've got to keep an eye on if we touch the upper Bollinger, which we haven't yet. Less than a pip away from it though. And this one we're definitely not. We have 20 bars to complete a setup from here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Highly unlikely that we get a long setup now, which is the pain in the ass. Julian, that's correct. We have 20 bars. And the 20 bars, just to be pedantic, is not counting the low. So we check is low here is 28. It's an equal bottom, so not counting. If it's an equal double bottom, not counting these two candles, so starting to count here.
In this
Dan, the end of a trend happens in 3 distinct ways. 2 are reasonably common. 1 is extremely rare. So let's look for it. Way number 1, we start trending from this bar. We stop trending in one of 3 ways. Way 1, we touch the opposite Bollinger. Way 2, we go 20 bars not counting the bar that makes the high. So 1, 1, 2, 3, 4, blah, 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 until we get to 20, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20 at the close of this bar. And the third way is if we get a close below both moving averages, then a close above both moving averages, and then a close below both moving averages. It's not very common, but it does happen. Clear?
So just to confirm something, Scott, the third method you mentioned for getting out of a trend, the above, below, above on the moving averages, does that have to happen all in a row?
Oh shit! Sorry, I was muted. I'm a dick. Okay, so I think I've been talking for about 30 seconds. I'm mute like a fucking idiot. No, that doesn't have to be in a row. And the rationale behind it is, if you look here, are we still in an uptrend?
You're talking about the wavy bit, I'm assuming, or to the left?
Like right here, right? Like the last bar.
Oh, the last bar.
Like not like according to rules, like just looking at it. You think we're going to go up or you think we're going to go down? Which is more likely?
Oh. To me, that looks like it could go either way at the moment.
Well, I mean, most people would say that's still a pretty solid up. Like the bar on my screen still looks like an uptrend, right?
Yeah.
Still looks like an uptrend.
Yep.
You couldn't rule it out. You couldn't rule out making new highs. Now let's go bar by bar. Definitely looks like an uptrend now. Still looks like an uptrend.
Yep.
That bar was really greasy, right?
Yeah, that's looking uncertain.
That's the exact moment when it's like, hang on, there's something rotten here. Like this is not right. So that's why it works. We use decreasing volatility on the 5 and the 10 as the fourth and final and least common type of confirming evidence. And the reason for it is, let's say we got a long setup and we look exactly like this, right? On the 10. Let's assume we've got a long setup on the 2 minute. This is definitely a trend that we want to be long, right? So if we have a setup on the 2 minute, that looks good to go. But we don't have a trend with pullback because the pullback's over. We don't have a lower Bollinger touch. We're not walking up the outside of the Bollinger Band. So decreasing volatility is a catch-all. Like, I really want to take this long trade, but it doesn't fit the rules. So that's how it works.
So Scott, according to my trading view, that's an equal close. Does that mean we're not in DV then?
Close 7, sorry, my bad. 03 equal close, not in DV.
Thank you.
You can see if we get a short setup here, we don't have confirming evidence on the 10, which is a good thing, because this would be a shitty place to go short. Market's already tipped its hand. This is a low probability short here.
And just backtracking a sec, what were we looking at with that DV mode being on or off there?
No, we're just checking if it's on.
On
And
the
it's
2 minute.
On the 2 minute. So easy way of keeping track of DV mode. As soon as you hit fresh ATR highs, you can't be in DV mode before that. So you only have to go back to the point where we hit. You only have to check the highest closes in the trend back to the point where we last made ATR highs for the trend. So the trend started here and we made new ATR highs here. So we only have to check this one bar.
Yeah, and it was, what was it an equal close with? That's the bit I'm confused about. What are we checking it against?
It's got to be the highest close in the trend. An equal highest close in the trend is not a new highest close in the trend.
Okay, so we're checking it against the shooting star right next to it.
Exactly so. It's cool. Lots of tricky little shit today that people need to know. I'm really happy about that. Okay, so we are in decreasing volatility mode now. You can see we've made the highest close in the trend, and we've done it on a downtick in ATR from 329 down to 323. So we're looking for trend following setups, which are hammer candles, which are going to be marked with a H when they occur, and they've got to touch at least the 8 EMA. If they touch this purple line, we're going to go for 2R. If they touch only the blue line, we're going to go for 1.1R. Now, the rationale is like a rubber band, the more it stretches, the more it's going to bounce. Easy to understand. Now, when you go into decreasing volatility mode, important thing is to immediately check, do we likely have confirming evidence? And let's look at this 10 quickly. Highest close in the trend on a downtick. You can double click this bottom panel and see, okay, we're in decreasing volatility mode on the 10. On the 5, oh, excuse me. On the 5, we start walking 054, so 220. So we're not walking up the outside of the Bollinger Band. So are we in decreasing volatility trending mode? And we are not in decreasing volatility trending mode on the 5. Excuse me for a sec, guys. Okay, so important thing to notice is what tosses us out of decreasing volatility mode is 2 things. Thing 1 is making the highest ATR value in the trend, which is here. Thing 2 is breaking a pivot too high in ATR. Pivot too high is an ATR value with 2 lower ones to the left of it and 2 lower ones to the right of it. This is not a pivot too high. So we're still in decreasing volatility mode. Arnold, yes, you do check high and tight. Hey, Tom, welcome to the call, buddy.
Scott, on the
Hey,
5.
Scott, thanks for the welcome.
Hey, Tom, you had a bunch of questions, man.
Yeah, mostly in regards to the new exit rules. So, I mean, I went to the masterclass like back in June, I think it was, and only really now like properly getting into trading it. But yeah, I see the exit rules have changed.
So it's very simple. On if there is Bollinger Touch on the 5 and trending on the 10, instead of going for 1.1R, we now go for 2R while moving the stop to break even at 1R. If we have trending, the same thing. So it's Bollinger Touch trending and trending, you're going for 2R, moving the stop to break even at 1R. And
Okay,
on the
got it.
hammers and shooting stars, if the hammer touches the 8 EMA only, we're still treating it like normal, going for 1.1R. If the hammer has a deeper pullback to the 21 EMA, then we're going for 2R, moving the stop to break even at 1R. And of the hammers and shooting stars over quite a large data set that hit the 21 EMA, 83% of them hit 2R. So it's a no-brainer.
Yeah, makes sense.
The rationale makes sense too. It's like it's a deeper pullback, more spring, more coil.
Gotcha. I had a couple of questions about automating some of the rules as well, if you've got time for those.
Sure.
So yeah, like the high and tight definition that I learnt in the masterclass and then in the course was, I guess, more subjective in terms of picking which swing points or.
So the vast majority, so this is not an issue for manual traders, but for algo traders, it's a big deal. So what I recommend algo traders do is high and tight is only controversial in Bollinger Touch situations, almost by definition. So Bollinger Touch is also the weakest part of the system. It's also where commissions have the greatest impact. So if you're an algo trader, it makes perfect sense to just disregard that part of the system and not worry about it and just use highest low in 25 bars, lowest low in 25 bars. Because as an algo trader, I can't sit here for 6 hours and take no trades day after day and then wait for a trade to happen. Like that's retarded, like I go insane. But it's no big deal for your algo to skip a few, to skip trades because you can trade more instruments. So for algo traders, what makes the most sense is to get a higher Sharpe ratio by trading subsets of this. And I would probably, if I was an algo trader, I would go probably deeper into the subsets of it.
Is that the same whether it's counter trend or with trend? So just the highest high or lowest low within the past 25 bars?
Exactly so.
Okay, that simplifies things.
So, Scott, just touching on the exit rules again for a second, you mentioned moving the stop to 1R. At what point do you move the stop?
Move the stop to break even at 1R.
Oh, it's break even at 1R. Okay. Now,
the reason for that is not necessarily that it's better. It's just that it's emotionally crippling when you get a trade that almost makes 1.9R and then turns into a 1R loss. It's going to fuck with your head, no doubt in the world. So even if that wasn't optimal, which actually it is, I would do that anyway.
Makes sense. And can I confirm that we're now in decreasing volatility in the 5 minute as well?
Yeah, we are. From a close to large part.
So we'd have confirming evidence on both 5 and 10 now if we were to get a hammer.
333, so the highest ATR value in the trend is 333. The highest ATR value since we've been in decreasing volatility mode is 332. So we're still in DV mode. So we're skipping this setup, which is right here. Like we have a touch of the Bollinger, lower close, shooting star, and then a higher close, and we have confirming evidence, but we're skipping it. And you can see that this is a perfectly good trade to skip. That's a shitty trade.
I got another question actually, Scott.
All right.
So, when calculating the targets, do you take into account the spread? So,
No.
no, okay. So, like on the chart, obviously we've got the bid price. Then, so if you're buying at the ask, though, then you just calculate the target and then you take the hit of whatever the spread is.
Exactly. Well, you don't. In a practical sense, you always enter on a stop limit, so so you're exposed to the spread. So if you think about the different ways that this can go, if we enter on a stop limit, we're not exposed to spread or slippage on the entry. If it hits our target, by definition, it's hitting the limit, so there's no spread there. We're only exposed to spread and slippage on a losing trade. So by doing things that way, we minimize our exposure to slippage.
Sure.
And for manual, not algo traders, I just do my calculations based on TradingView, whatever numbers TradingView shows, and then I walk over to my other platform and I enter the orders. It's I keep it very simple. You know, there was a trade earlier today that was a winning trade that was a trade on my Interactive Brokers data, but it wasn't on TradingView, and I didn't take it because I only take it off the TradingView data. And that's not necessarily the best way or the smartest or the most correct way. It's just the way that's easiest to live with day to day for me. And other people have found the same too. Simon, I believe we're in decreasing volatility on the 5, but it's irrelevant because we're walking up the outside of the Bollinger Band. So personally, some people will be super pedantic and keep track of everything all the time. I don't at all. Like as soon as I've got one type of confirming evidence, I stop looking. Like I just don't care. We're out of decreasing volatility mode. We've broken this pivot too high here. And so now we're looking for short setups. This could very well be a short setup. Do we have confirming evidence? 293, the high is 294. So yes, we have confirming evidence. If this is a shooting star in a minute and a half, that's a setup. Okay, well, that's kind of weird, but what the fuck? Let's take it anyway. Okay, so start prepping an order. The entry would be 25 and a half. The stop loss would be 29 and a half. That would be 4 for 4 and a half. I'm gonna prep that order now. Probably not going to close as a shooting star with a minute to go, but it could very well be, or yeah, it may. Who the fuck knows? One of the things I want to point out to you is that we have, it could be a higher close too, is that we have this outside bar, and outside bar, inside bar is a very common and classical topping pattern. So the close here, 266, this either needs to be a shooting star in 20 seconds, or it needs to close above 266. Arnold, that's a really good question. Let me cover it after I place this order. That is an order, by the way. All right. Okay, everyone got that order, please? So Arnold, for Bollinger Touch, what we look for is put your cursor over this bar and the equivalent bar that makes the same candle on the 5 and the same candle on the 10. The rule is it has to be within one candle either side. But in a practical sense, 99% of the time, it happens on this same candle. So for Bollinger Touch, it's the candle that touches it. Okay, we have a fill. And 4 for 4.5. That is a nice looking setup. It's possible that we go into decreasing volatility in this bar, though unlikely. Something I want to point out that's really interesting is that those of you who are in this trade, you will naturally be feeling anxious when you're in a trade and it's going against you. I'd encourage you just not to look. Just, don't even look. That's the way I feel about it. Okay, I'm stopped out. All right, guys. That might be enough for me today. Yeah, feeling kind of sick, and yeah, I've had a nice day trading. Hope you guys learned something, and yeah, grateful to be here for you. Any questions, feel free to email them. All right. See you guys.